and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gives you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Local units and local hiring are measures to fight protectionism have worked well for Mahindra Group on the sidelines of the World Economic Forum in Davos. He speaks to Menka about the importance of being seen as a local player wherever one sets stop. Let's listen into what he had to say.
You open facilities there for assembly. They don't necessarily mean huge capital expenditure. You can do it with partners, as we've done in Bangladesh. But there are many modalities by which you go local. And then quite apart from the investments that you make, it's also about the kind of people you employ. You need to employ people who are local. You need to get local champions. And you need to give back to the community. I mean, that's what Davos is all about. It's not nice to have fuzzy stuff. Our tractor business in America, we were the first after Hurricane Katrina to be out there helping to clean up the mess. I think that's borne long-term dividends for us. So your culture, the texture of your recruitment and your investments in assembly or manufacture, I think all will determine how we define being local.
What I mean to ask is, how many more countries do you intend to deploy this strategy to? What can we look forward to in the way the international contribution to M&M's revenues will change over the next 3 to 5 years?
You know, we're already about 49% global. I was surprised myself.
You're talking on a consolidated basis?
Consolidated. Okay. A lot of that is because of Tech Mahindra, obviously. But it is also because of companies like SsangYong. And we made acquisitions in Finland and in Turkey. So unbeknownst to us, we've suddenly become much more global than we had even plotted to become. So sometimes these things are serendipitous, they happen because of opportunity. We don't have a board somewhere which says we must be global. That's not an objective in my opinion.
Okay.
We must be profitable. We must grow.
Sure.
Then you look at where you grow. There's an equally strong lobby within the group that let's consolidate, let's not fight too many battles, let's focus on certain countries. And so we're always having that discussion. And we have to decide which countries do we focus on. That's an ongoing discussion. So you won't find completely profligate expansion everywhere. You will find that we are doubling down in countries where we are seeing success.
Okay, let's welcome our expert then. Senthil, Manikandan of Newbury Capital and Avinash, Gorakshakar of Joindre Capital join me on the show. Thank you to both of my guests for joining me. Today on Hot Money, we'll discuss the results from ITC. Came out with numbers yesterday. Yesterday was down almost 5% in trade. Today has managed to recover, so we'll ask them about that result. We'll talk about Info Edge. Info Edge is trading at a record high. What's happening there? ICICI Prudential was down almost 11% in trade yesterday. What should one do now? And Page Industry has fallen all the way from levels of 36,000 to all the way down to close to 20,000 now. Should Page Industries be accumulated at that level? So these are the stocks that we'll talk about it. First one, ITC, came out with numbers yesterday which were in line with estimates but did manage to fall almost 5% in trade. Today it's managed to recover a little bit of lost ground, but what's the way ahead for ITC is something we'll ask. So Avinash, I'll start with you. Were you surprised with the big 5% fall in ITC yesterday?
My sense is I think the markets expected a little better number on the profitability, and I think clearly I think now with the interim budget lined up ahead, there are some expectations that going forward cigarettes could again be taxed heavily. So I think broadly numbers were in line but were not really exciting enough for the stock to get re-rated. In fact, most of the broking houses numbers were penning in a better kind of earnings number. I think if you read the press commentary, I think cigarette business has definitely taken a beating on the margins. The only savior was the paperboard and the FMCG basket of products. So I think clearly the cigarette business, which contributes a large part to the overall EBITDA portion, has actually done a little badly on the EBITDA margin side. So broadly I think numbers were not exactly very exciting, and that's the reason the stock actually fell off.
What are you advising your clients to do on ITC now?
In fact, we don't advise any fresh buying. We have been, earlier we had recommended the stock. So we have told our clients to actually hold on, Darshan. Largely, I think this company will definitely, do better once the budget gets cleared, and hopefully if the taxation impact doesn't come in and, there's a status quo, then I think you could possibly see some sort of further interest coming back again. Okay,
Senthil, what did you make of ITC's numbers?
I think among the business segment, I think the top two segments, that is the cigarette and FMCG, both did well on the top line. I think margins pressure was there on the cigarette business. But on the volume side, I think expectation was around 4-5%, but they have done a volume growth of around 8%. So that was on the positive side. Like Avinash mentioned, I think the stock has always been impacted more on the tax side versus the earnings potential of the business. So I think the sin category stock, both even ITC and the liquor stocks get abnormally impacted because of the tax concerns, both at the state level and the central. Whenever there is a shortfall at the cash tax collection, I think they become the first level impact for this tax hikes. So on the FMCG side, we remain quite positive because it's tremendously valued less than the other FMCG players, even though at the operating level they are improving. Like for this quarter, they done an operating profit of around 76 crores versus 47 crores last year. So operating level profit at the FMCG level is improving. We remain positive on this FMCG business over the long term. But valuations wise, it has remained at the same 26-27 times 1 year forward earnings for the last 3-4 years. So returns has been nil. So unless there is some clarity on the tax level plus huge improvement in the operating level of FMCG business, we don't expect any re-rating on the stock.
Okay, do you think that high dependence on cigarette business is the reason why valuations will always remain subdued despite them doing well? Because if you see all the sectors, they did double-digit growth in the paper business, in the hotel business, in the FMCG business, but somehow the overhang of the cigarette is something that will play way down on the stock?
Yes, because cigarette business at the profit level, it still contributes 80%. So all other remaining 4-5 business segment contribute just 20%. So to take the remaining business to around 50% level, say FMCG has to contribute abnormally. That will take over time because even though it has been 10 years since their foray into FMCG, I think they are yet to break even and they are in the investment phase. Even though they have built 4-5 brands which are like billion-dollar brands like Ashirwad or in the chips category like Bingo, I think it will take at least another 5-6 years to see a good operating profit at the FMCG level. I think till then, I think the re-rating is quite the probability of re-rating is quite less.
Okay, Avinash, do you think that the tide for FMCG is changing this quarter? Because even you saw that counters like Asian Paints came out with strong set of numbers. Consumption, basically, I'm saying the counter was down in trade. You saw how Pidilite came out with numbers and is down in trade. Even HUL wasn't that exciting. So you think that now valuations compared to ordinary numbers are something that probably is making this sector a little nervous?
No, I think clearly in terms of volume growth, Darshan, the numbers have been quite good. You rightly mentioned that if you look at Hindustan Lever numbers, volume growth continued to be in double digits. But I think on the margin front, there has been some compression. And I think if commodity prices rise and these companies are not able to pass through the cost, valuations definitely are not going to improve in a hurry. They already trade at expensive valuations. So I think at least in the near term, at least for the next 1 or 2 quarters, you could expect sideways activity. And overall, I think over the next 1 year, hopefully if the volume and the margin improvement comes in, then only we could see a little bit of re-rating. Otherwise, these could be at best be market performance.
Okay, and any of the stocks in the consumer names that you're recommending to your clients?
In fact, within the FMCG basket, I think stocks like Marico, for example, or Dabur, we believe that, these are names which still could possibly provide a decent risk reward to investors. Marico definitely has, not performed the way other FMCG stocks have performed. But overall, despite the fact that copra prices have gone up, they have a decent amount of pricing power. And I think here one could look at possibly, nibbling and buying small quantities on a decline.
Okay, so that's the view that's coming in on the first stock, and that is ITC. The second stock we want to discuss is Info Edge. Pull up the stock and let's see what it's doing in trade today. Today is absolutely flat in trade, but it did manage to hit record highs. So the traction certainly seems to be on the positive side. It's in the last 9 months, it's up 40%. In the last 1 year, it's given returns of 25%. So what's aiding the rally for Info Edge, and will this rally continue, is something that we want to discuss with our guest. So Senthil, Info Edge, what do you make of the business? Will this rally continue?
So I think the recent traction in the stock might be mostly with respect to the traction in the food delivery space. I think Info Edge, via its 27% ownership in Zomato, I think there has been a recent fundraising wherein the food delivery startups are seeing a valuation of over $1 billion. So all these have become unicorns, and the growth rates are pretty high. The competition is also high with third level player like Ola is coming in, plus and also like Uber Eats is also upping its game. So competition is there, but Zomato is doing well, being a number 2 player with Swiggy taking the number 1 place. So I think that's a major reason could be the returns we are seeing lately in the stock price. But apart from that, their standalone business, Naukri continues to do well, and it's being a huge cash generating for them. While 99 acres and Jeevan Saathi continues to lag, I think it's still in investment phase. So apart from this, we are quite positive on the Naukri business also, because we are seeing lately the IT hiring has picked up, and IT is one of the major contributors for the Naukri. So on the standalone business, we are positive on Naukri, and also on their investment business, like Zomato is doing well, and also their ownership in Policy Bazaar, that is also doing well. So we remain positive on the business.
Okay. Do you see the slowdown because of the NBFC crisis on real estate have a impact on 99 acres which they own? So will that be a concern?
Yes, actually 99 acres has been a laggard, because starting with RERA and last 3-4 years real estate has been in the downtrend. So they have been loss making at the EBIT level in 19 acres. So that may continue for next 1 or 2 quarters. But I think 99 acres compete with Magic Breeze, so they are the top 2 players. So I think over the next 1 or 2 years, when the real estate stabilizes, I think they will be able to bring out the potential what they have built in 99 acres. So it's a long-term bet on the structural story of internet startups.
Okay, Avinash, what's your view on InfoEdge? What do you make of it?
No, I think Darshan, as Senthil pointed out, they have a lot of premium, digital properties like Zomato, Naukri, Policy Bazaar, and I think this business has to be looked upon from a 2 to 3 year perspective. I think in no way, if you look at the current valuations, this stock may look justified, but looking at the kind of digital business growth over the next 2 to 3 years, I would be happy to buy this stock, as a portfolio stock, provided the time horizon is at least 2 to 3 years. But overall, I think numbers are yet to come in, from properties like 99 acres or typically Policy Bazaar. But overall, I think this stock is somewhat of a unique stock. Very few of such companies are listed on the markets. So I think in that terminology, I think one can look at it, but from a longer term horizon.
What's your view? Because I think if you're playing the Zomato theme, I think most of them, the game is basically valuation, not the bottom line. That's not something that's working. And basically they have a exposure to it. So that's not part of the core business of InfoEdge. Is that a concern that you would have?
See, I think you're right. I think it's only a valuation game, and I think in these businesses, the management has clearly said that they would not be expecting cash flows to start right from day one. It would take a gestation period of 2 to 3 years. So I think Naukri is definitely one of their key verticals, and hopefully the economy picks up. You could see a lot of revenue and profitability coming in from Naukri, which is going to be its cash generator. So I would say that yes, it's expensive, but definitely looking at the longer term prospects, any decline could be used as an opportunity.
And what about the slowdown in real estate? Would that be a concern for you for 99 acres?
Actually, I wouldn't be so concerned, because they are basically intermediaries. They are not actually directly into the real estate market. I would believe that despite the fact that the turmoil is there would be some genuine buying, and I think real estate, at least my sense is that clearly property, proper locations and the right properties, the market still looks quite attractive. There is a market which will grow, but yes, maybe you'll probably have to look at it from a longer term angle. Okay,
so that's the view that's coming in on InfoEdge. Pull up Pidilite Industries. They came out with number. Fevicol Makeup Pidilite Industries stumbled the most in a month after reporting a weak set of numbers. It's down almost 3%. While the company managed to report double-digit volume growth, it was the margins that took a hit due to the rupee depreciation and high raw material cost, and that is why you're seeing that the counter was down almost 3% in trade, even though volume growth was rather strong at 11%. Yash Upadhyay caught up with Apurva Parekh. Apurva Parekh is the executive director of the company, and he wants to find out what were the other factors that spoiled the earning picture for Pidilite. So if you want to get a sense of what went wrong at Pidilite, you should listen in.
See, VAM prices in the third quarter were upwards of $1,300. As compared to that last year, they were in range of $900 to $1,000. Fortunately, now the prices have again moderated, but in the third quarter of this year, they were significantly higher than same period last year.
Okay.
In addition to that, also the rupee, there was some depreciation. So both this factor had an impact on our input costs.
So Apurva, in a situation like this, now that we have VAM prices cooling off and the rupee too has stabilized, do you expect to continue the kind of margins that you've been doing in the range of higher than 20%?
See, I would not like to give any margin guidance, but I would like to clearly say that we expect reasonable improvement in margin in the coming quarters due to two reasons. We have taken some price increase action, as well as there is moderation in input cost and rupee seems to have stabilized. So due to this factor, we do expect reasonable improvement of margin in the coming quarters.
Apurva, what has been the quantum of these price hikes? Can you help us understand that? And also, do you feel the need to take any further price hikes in the fourth quarter?
In some of our major categories, in this year, we have done price increases, around 5%. Going forward, based on the current scenario, we are unlikely to do price increase in major product categories. We may have some price increases where it is required. However, it is unlikely that we will have price increases in our major product categories in the coming quarter.
Okay. And there hasn't been any price hike so far in the fourth quarter as well?
Nothing significant, no.
Okay. So then, Apurva, coming to the key positive, we saw 15% growth in your top line, aided by an overall 11% growth in volumes. Which are the product segments that are doing very well, and how are you seeing demand shape up over the next few quarters?
So many of our major product categories, adhesives and sealants, construction chemicals, have shown good growth in this quarter. So growth has been across many of our product categories and across geographies.
Apurva, so the reason actually I ask you this is because we had Asian Paints also come out with their numbers a couple of days back, and the management commentary with respect to demand was slightly weak, or they expect some uncertainty because of the political environment. We have the general elections later in this year. Do you think that this would have any sort of impact on demand?
See, it's very difficult to say, and we would not like to comment on what we believe how the growth rate will be. There are so many factors which could influence the growth rate. So we would rather not give any comment on how we see the growth in coming 1 or 2 quarters. But directionally, we believe that we are making good progress. We are now having steady, consistent double-digit volume growth for several quarters. So directionally, we believe we are in the right direction. But due to macroeconomic factors, there could be some impact on growth in 1 or 2 quarters. But overall, we believe that we are moving in the right direction.
So then, Apurva, can you help me understand what has led to this degrowth in the industrial products business? Because there was a 2% drop in volumes there in the third quarter. Is this largely a one-off, or do you expect some pain in the few quarters or something like that?
See, in industrial products, there are several factors that impact the growth. Primarily, it is the demand from some of the consumer segment that we supply. We see weakness in some of the segments which are like, industrial resins or segments related to leather, footwear, textile. So some of the segment, we have seen some weakness in demand. Also, in a rising raw material scenario, there is also, there is a lot of competition, and that also has created some impact. We also export a reasonable amount of these industrial specialty chemicals, and hence the global demand also has an impact on the growth. So as far as industrial specialty goes, several factors have impacted growth for both the current quarter and for year to date. However, we as a company continue to work and take several initiatives to improve the growth rate.
So then, Apurva, in order to achieve this consistent double-digit volume growth, are there any new products lined up for the next financial year, and how does your product pipeline look like?
See, our product pipeline is robust. We have various projects in pipeline in most of our product categories. In Pidilite, we continue to add new products on a continuous and a regular basis, and hence you will see several new products coming out in the coming years.
Okay. Any timelines with respect to those product launches? Are there any happening in the current quarter?
No, it would be difficult to share before the product is actually launched, for obvious reasons. However, as we have done in the past, in most of our product categories, we introduce new products every year. Some of those are variants or extensions, and some are new products. So we have several products in pipeline, and we will introduce them on a regular basis. But it's difficult to share the detail before the products are actually launched.
Okay, the next stock that we want to talk about is ICICI Prudential Life. It was down almost 12% in trade yesterday. The downside continues in trade for the counter also. What's the way ahead for ICICI Prudential? We'll ask our guest. So, Avinash, would you recommend accumulating ICICI Prudential after this big fall, and what did you make of the numbers?
No, I think numbers were definitely Darshan disappointing, considering the fact that the management mentioned in its press release that the business actually suffered both on the life and the annuity side, and the investment income also in this quarter was substantially lower. All this resulted in a fall in the profit. I think clearly, at least for the next 1 or 2 quarters, I would be little cautious. But at the same time, I would like to mention, this stock is now below its IPO price of 334, and I think any further fall below say 300 odd rupees could be a good, decent fit for a long-term kind of portfolio choice. Considering that in the life insurance market, it's a big player, and this is a long-term business. So looking at a company like this on a quarter-to-quarter basis may not be the right strategy.
What about the other insurance play? Is insurance a theme that you're telling your clients to apply to?
Actually, we have suggested 1 or 2 names like HDFC Life and SBI Life. I think clearly these are more stable names. HDFC Life commands a premium, and I think clearly in terms of the Q3 numbers, they were definitely better than ICICI Pru. We saw 18% rise in profits. So I think clearly longer term money can be made, but in the short term, Darshan, this business is not a quarter-on-quarter kind of number to be actually tracked closely.
Okay, what about you, Senthil? What's your view on ICICI Prudential?
So the Q3 results, as Avinash mentioned, was lagging its industry peers, because both SBI Life and even HDFC Life both posted a gross premium growth upwards of 25%. But ICICI Prudential, I think their product mix is not optimal compared to other players, because they have a heavy dependence on ULIPs. ULIPs is 80% of their product category. And I think they are more going into the protection business as the other peers. So in the short term, I think there will be some pressure on the margins, because there is a new business strain with the premiums which they are getting is not even able to sufficient amount to service the acquisition cost and the reserves they have to put in. So with the new business strain coming on, I think there will be some impact in the short term on the P&Ls. But over the long term, I think they should do well with bringing up the product mix to the optimal level. But over short term, they will face some pressure. But the valuations are heavily discounted to the peers, like HDFC Life trades at around 4.5 times price to EV, while ICICI Pru trades around 2 times price to EV. So the value, there is some amount of valuation comfort. But purely on the business side, I think SBI Life and HDFC Life saw the better picks in the life insurance space.
Okay, so that's the view that's coming in on the insurance space. And before we wrap up, Page Industries is another counter. Has fallen massively from levels in excess of 35,000. Now it's close to 20,000. So let's pull up. I think it's 23,000 right now. Over the past few days, it has been managing to inch up. What should one do at Page Industry? Is it still expensive, or would you take a venture after almost a 12,000 rupee drop? Senthil, what would you do advice on Page Industries?
I think still the stock is expensive, because business-wise it's a great business. They are making ROE of upwards of 45%, and they have a long-term growth trajectory where the management is highlighting 20% growth for the next 20 years, and their license pack with jockey is also till 2040. So there is we can see a longevity of the business continuing with margins in line with what they are posting it now. Q2 was below expectations. We have seen volumes pretty much flat, and the sales growth of around 10%. So I think quarter on quarter we not track the business. It has to be long-term basis. But if you look at the valuation space, it still trades at a 1-year forward PE of around 60 times. So that is not having any margin of safety in the stock. So we are just avoiding the stock as of now.
Okay, what about you, Avinash? What are you recommending your clients on Page?
No, I think as Senthil said, we also find that the valuations, Darshan, are quite expensive, 60 times on FY20, and I think clearly if you look at the margin picture, I don't think in the near term the margins are going to improve. The stock definitely will remain range bound, and as Senthil said, the business is really great, but from an earnings perspective, I would believe that the next 12 to 18 months would be challenging, and I think clearly competition is picking up. So I think here possibly one could possibly look for the further decline to re-enter, maybe at levels of around 17,000-18,000, but current levels definitely appear to be expensive.
Okay, so that's the view that's coming in on Page Industry. With that, it's a wrap on this edition of Hot Money. Thank you, Avinash, so much for coming in. Thank you, Senthil, so much for coming in today. Ask BQ comes up next. Stay tuned to Bloomberg.